This month I am republishing an excerpt from our May 3rd, 2012 InfoMovie report. There is an old City of London adage that says sell in May and go away and come back on St. Leger Day. US traders are more familiar with the sell in May part, but incidentally the St. Leger is a horse race traditionally held in September. By way of background, let's lead in with a reference to a leading stock group, the brokers, which were referred to in a previous InfoMovie issue. I recently drew your attention to the price action of the early leading brokers ETF, the IAI. We observed that it had diverged slightly with the S&P at the recent peak. However, in the last couple of weeks or so, a divergence of a more serious nature has arisen as the S&P has rallied and the IAI traded lower. This appears to reconfirm this head and shoulders distribution pattern. Since brokers typically discount the overall market, this is not a positive sign, which brings us to the question of whether we should sell in May and go away. A Google trend search shows that for the last few years, let's call it SIM, has received a high number of press reports, yet in the last 2 years, SIM has worked quite well. Does that mean that contrary opinion does not work? Quite the contrary, so to speak, and that's because the majority of these articles claim that SIM does not work. So the contrary view is that it does. Just look at the comments above the red underlined text. A click on the links for F for the latest period shows once again the skeptical nature surrounding this concept. Bearing that in mind, I think it's important to put the interpretation of SIM into perspective. For example, if the technical position is sound, it's unlikely that it's going to work. Look at this chart and the intermediate KST. The vertical lines mark the beginning of the month of May. These green arrows show KST buy signals in a bull market. We would certainly not expect to see prices decline, especially when the bull was quite young in 2 of the instances. These purple arrows show buy signals again, but these were quickly reversed because of the bear market environment. Finally, these downward pointing red arrows indicate sell signals that were either followed by a sideways or more likely a downward correction. And that brings us to the current situation, where the KST is overextended and starting to reverse. Ingredients for a correction, I'd say. Finally, this chart shows a composite of years that meet the following requirements since 1900. These are the 4th year of the presidential cycle, the 2nd year of the decade, and the 13th year of a secular bear. It called for weakness starting in March and progressing until the first week of July. Given the late March, early April peak, this cyclic path is so far on track in terms of direction, but not yet in terms of magnitude. In any event, it certainly does not contradict the SIM scenario. Moving back to this chart again, you can see that regardless of KST signals, SIM worked in 8 of the last 11 years. If you like this form of presentation, it comes in the form of our InfoMovie report. It's a 7 to 10 minute audio-visual presentation like this one. It's published 48 times a year and covers US equities, bonds, the dollar index, gold and commodities. And you can get a sample copy or subscribe at pring.com. In the meantime, good luck and good charting.